Okay, hi everyone. So welcome to today's session, right? So for today, we will be doing on an introduction to indicators. So I'll just give it about 1 to 2 more minutes for more people to stream in before we get the session started. So let me just share my screen. All right, so as always, if you guys have any questions, please don't hesitate to put them under the questions chat. So we will be starting in about 1 to 2 more minutes. Right, so I'll also leave the question Q&A box open as well, so that if you guys have any questions, I'll be able to attend to them. Okay, so for those of you guys who just joined, right, welcome. So for today, we will be doing mainly on introduction to indicators, right? So this will be covering trend following indicators as well as oscillators. So just a brief introduction of myself, right? So I'll be doing the webinar for today. So I'm an FX strategist. I also provide analysis to institutional clients, and I'm part of the team recognized by the Technical Analyst Awards as finalist for the best FX research for 4 consecutive years. You can also find me on LinkedIn. So if you guys have any questions with regards to the webinars done on Wednesday, Thursdays, and Fridays, please put them under the questions tab here, right? Or if you're watching a recording and a session question comes up after, you can also reach out to me on LinkedIn. So just a quick disclaimer before we get the session started. So the information presented over here, it's not to be treated as investment advice. It's for educational purposes only. So this is the agenda that we will be covering for today, right? So we will first go cover trend following indicators. So for this, we will be covering on the moving average as well as the MACD. And then following that, we will be covering on oscillators, right? So for this, we will be covering on stochastics and RSI. And after the session, we will also be doing a quick summary of the indicators that we have covered so far and what are the learning points to take away from that. So along the way, right, if you guys have any questions, don't hesitate to put them under the questions chat, and let's start the session. So let's first start off with trend following indicators. So in this case, right, one of the most popular trend following indicators that we have, it's the trend moving average. So you can see that in general, moving average themselves, right, it works better in a trending market. So another question that will often be asked is that how do you determine if it's a trending market? So as we've covered in our earlier sessions, as well as the live analysis, right? So for trending markets in general, you can look at market structure. So when prices are forming bullish market structure, as you can see here, right? So in this case, if it's a bullish market structure, where prices are basically forming your higher lows and higher highs, in this case, this would be an uptrend. In a bearish market structure, however, this would be a downtrend. So in this example, you can see here. So in this example, you can see that this is a bearish market structure, right? Just noting the highs and lows that were marked out. So the highs are marked out in blue. So this blue dots that we see here. And then for the lows, they are marked out in gray. So this itself, you can see that prices are in a bearish trend. So that's one, right? And the moving average, which is denoted by this blue line that we have here. So this moving average can act as a dynamic support and resistance level. So in this case, right, in a bearish market structure, this would be a bearish trend, right? So in a downtrend, moving average itself can act as a dynamic resistance. The reason why we use the word dynamic resistance is because dynamic itself means that it's constantly changing, right? And moving average is actually determined by taking an average of a specified period and then taking the average price, and this is updated constantly when price changes. So this is the reason why it can be a dynamic resistance, right? So you can see that in a downtrend itself, what happens is that this moving average would serve as, you can imagine it as a descending trend line, but this trend line changes according to price, right? So it tracks average of the previous period prices. So in this case, you can see here, right? This is the reason why we mentioned that moving average can act as a dynamic support and resistance level. And the thing to take away from here is that you can see that when prices are holding below the moving average, generally it provides a bearish signal. And when prices are above the moving average, it's a bullish signal, right? So when price crosses above the moving average, it would be a bullish signal. When it crosses below, it's a bearish signal. But of course, even though this is the general idea behind it, right, do take in mind what is the general direction of the trend, right? So is it in, number one, is it actually in a trending market? And also the second thing is that if it is in trending market, right, what is the market structure like? Is it forming your higher lows and higher highs, or is it forming your lower lows and lower highs? So those are the things to take note of. So one other thing to take note of here is that if you look at moving average, right, so the slope of the moving average can also give us a clue as to the direction of the trend. So moving average itself, when it's sloping downwards, it gives us, it essentially shows that the trend is bearish, whereas if it's sloping upwards over here, it's a bullish trend, right? What is also important to keep in mind is that because this itself, it's a trend following indicator. So what this shows over here is that for moving averages, right, when prices are in a trend, in a trending market, it tends to do better. Whereas in a ranging market, you can see that there will be many whipsaws. So in this case, right, this example that we see on the chart, specifically, this is in a trending market, which is why you can see that this moving average will act as a dynamic resistance here. So there are different types of moving averages, right? So examples of them would be your EMA, SMA, WMA, and TMA. So EMA essentially means exponential moving average, right? So in this case, what this means over here is that this itself, the calculation of this exponential moving average would give more weight to recent prices. SMA means simple moving average. So for simple moving average, what this means is that there is an average, right? So let's say if you have a 10-day SMA, so 10-day moving average period, it will take the past 10 days, so, or the past 10 period, right? So the prices of the past 10 periods, and it will take the average of that to determine the SMA. For WMA, right, so this is a weighted moving average. So this gives specific weights, right, depending on the period, right? So you can do like a 20% of, or maybe like a weightage of 2. So if let's say, for example, let's use a 5-day moving average. So day 1, day 2, day 3, day 4, and day 5, right? So assuming that you have different prices in each day over here. So what this shows is that you can take the weight of the first day multiplied by the price, and then likewise for the second day multiplied by the price, and so on and so forth, and then take the average of this divided by the sum of this number of days here. So this is a weighted moving average. And then the last one, it's TMA. So TMA means triangular moving average, right? So for this, it gives more weight in the middle price series. So essentially, this is what TMA means. So all these moving averages can also be found on TradingView, so you can also load them on TradingView as well, right? And what's also important is to take note that market structure itself also helps in determining the trend direction. So as we've mentioned so far, right, bullish market structure itself, when prices are trending higher, in this case, moving average in a bullish market structure, more likely than not, it's going to act as a support level, right? Whereas in a bearish market structure, in this example that we see here, what we have is that in a bearish market structure, this moving average is likely to act as a dynamic resistance. Okay, so if you guys have any questions, right, please don't hesitate to put them under the questions chat, and let's move on to the next slide. Okay, so the next one that we have, it's on MACD, right? So MACD itself, we have, it's basically MACD short for moving average convergence divergence. So in this case, it measures the momentum of the market. So MACD, the calculation for this is basically taking the difference between the 26-day period of the EMA, right? So subtracting the 26-day period from the 12-day period. So how you can imagine this is that the 12-day EMA, so we covered EMA previously, right? So EMA basically takes the average, so it gives more weight. So let me just draw this out, right? So on the 12-day EMA over here, right, essentially it gives more weight to the 12 period, not 12-day, right? The reason why we use period is because if you're on a 1 hour, then that would be 12 hours. So 12 candles essentially. So in this case, right, in a 12-period EMA, what this shows is that 12-period EMA itself would be more sensitive to price changes compared to the 26-period EMA. So when your 12-period EMA it's above the 26 EMA, then this will essentially mean that your MACD line it's above 0. So essentially this MACD line, right, the one that you see over here, this is actually seen or shown by this blue line that we have on this MACD indicator. So in this case, this MACD line itself, right, you can see this blue line here. So this is actually calculated by taking the difference between the 26-day EMA and the 12-day EMA. And what this does essentially, right, the calculation of this basically compares the shorter term and longer term momentum. So the longer term would be your 26-day EMA. The shorter term period would be the 12 days EMA. Okay, so this is what we have. And you can see over here, right, for MACD itself, there's also this thing called the bullish and bearish divergence, right? So what divergence means essentially, right, it's just a difference, right, in terms of how price and the indicator it's moving. So in this example, you can see that for divergence, right, essentially this is a bullish divergence that we're seeing, the one in blue here. And how so? You can see that prices are pushing to form your lower lows. Whereas this indicator itself, the MACD, failed to make a new low. So you can see that if you look at the lows itself, right, prices are forming a lower lows over here. But for MACD itself, you can see that prices are actually forming higher lows. So there's a divergence. Essentially, they're moving in different directions, right? So this is the idea of divergence. So you can see over here, right, once this happens, this is a potential bullish signal. Of course, not just trading on every divergence, but the idea is that if prices are sitting on a key support level on the higher time frame, it's showing us that there is bullish structure. And along with that, you see that there is a divergence over here. This can signal potential reversal. So this is on divergence, right? So in the next session, we will also be covering in deeper details, essentially how we can combine moving average and MACDs, and also how we can actually find strategies from that. So that will be covered in further detail in the next Thursday session, right? So this is just a brief overview of what indicators are. At the same time, what are the things to take note of in specific indicators? And if you guys have any questions as well, right, don't hesitate to put them under the questions chat. Okay, so let's take a look at the other indicator that we have. So the next one that we want to cover would be on still the MACD, right? So it's basically more details on the MACD. So for this, previously we covered more on divergence. In this example, right, or in this slide rather, we will be covering more on the MACD line, the signal line, as well as the histogram. So just understanding more on this. And you can see that for the MACD line, it's represented in blue. Okay, so I have a request, right? Can you demonstrate MACD on the current trend of gold? Thank you. So let's take a look at that in a while. Okay, so we'll hop on that onto the trading view chart in a while. So in this example, you can see here, right? So the MACD line itself. So MACD line is represented by the blue line. The signal line is the orange line. And then we have the histogram. You can see the histogram here as well. This is the histogram. Okay, so we have the MACD line. So MACD line, it's the blue line. So essentially, when the MACD line goes above 0, right? So recall the MACD line itself is the difference between the 12-day and 26-day EMA. So when it goes above 0, what this shows us is that in the shorter term momentum is stronger, right? Because your 12 days would be stronger than your 26, which is why when you take the difference, it's more than 0. So in this case, right, there is bullish momentum. If your MACD line is less than 0, it shows that your shorter term or your longer term momentum is stronger. So your shorter term momentum is weaker, right? So in this case, this is why MACD is below 0. So imagine this, right? When there is a sudden strong movement, in this, right? So in this example, I'll refer you to this on dollar index. So I think 3 days back, right, we saw the CPI data release, core CPI data release. So what happened is that the CPI data, core CPI data came in at 0.6% in August, right? So it exceeded estimates of 0.3%. So in this case, right, when inflation is already standing at a very decade high in US, right, having such data could also prompt the Fed to basically adopt more aggressive interest rate hikes. So when this happens, what it shows is that it's this immediate news release, right? There is a strong bullish pressure for the dollar. And this huge candle that we see over here, right, it corresponds to the MACD. You can look at the MACD here, right? So the MACD line again, right, it measures the difference between your 12 days and 26 days. So when there is such a strong momentum up, right, this momentum itself will impact the shorter term moving average more. The reason for this is because the average, right, so moving the 12 days moving average just takes the average of the past 12 days. Whereas for the 26, right, it takes a longer period. So in this case, it will have a higher impact, right? Sudden burst in momentum would have higher impact on your shorter EMA. So in this case, what happens is that you can see that there is this strong, sharp movement up in the MACD. So let me just clear the drawings and highlight this area. So you can see that corresponding to this strong bullish momentum that we have over here, the MACD blue line that we have, right, there is this sharp spike up here as well. So this is on the sudden movements, right, where you can see that huge movements, usually this would be caused by the higher impact news. This can also cause MACD to rise sharply. So the next one that we have over here, it's the signal line, right? So signal line is represented in orange. So in this case, right, it's the signal line that we have. It's actually the 9 days EMA of the MACD itself here. And it shows the difference between the MACD and signal line, right? So this is the histogram. So if you look at the histogram, this is basically the histogram, the ones that you see in green and red here. So essentially, this shows the difference between the MACD and signal line. As you can see, right, when the MACD is above the orange line, you can see that the histogram, it's above 0. When the MACD is below the orange line, right, the signal line, then this is when the histogram is red. So it's below 0, essentially. So MACD, right, the blue line, when it's above the orange line, it gives us a bullish signal, and histogram is above 0. When the MACD is below the orange line, the histogram is below 0. Okay, so this is basically how we can use MACD, right? Let's take a look at the other slide that we have, right, before we hop on to how we can use MACD on gold. Okay, so now we will be moving on to oscillators, right? So I'll just bring out my chart. And if you guys have any questions as well, right, do put them under the questions tab. Just give me a moment as I bring up TradingView. And if you guys have any questions as well, right, don't hesitate to put them under the questions chat. So this would be just basically looking at how we can use MACD on gold. So let's take a look at gold, where it is now, right, and how MACD applies on gold. Okay, so I have the chart, right? Can you guys see my screen? Just give me one moment as I bring it across. Okay, so let me just remove all those drawings, right? Can you guys see my screen? You should be seeing a TradingView, the TradingView setup here, right? So if you can see my screen, can you just put yes under the questions tab? And I hope that the connection today is not laggy, right? Much wider bandwidth. Okay, so if you can see my screen, can just indicate it either under the questions chat or chat box, and we'll take a look at gold. So let me load MACD. Okay, so this is what we have for MACD, right? So essentially over here, you can see that we're on the daily chart. So this is just basically seeing how we can actually apply MACD on the charts, right? So recall that this region itself, right? So we have the first thing first is still look at market structure on Go, right? So on the daily time frame, you can see that if you want to focus on this portion of the chart, so generally I will look at this portion of the chart, given that this candle itself represents a one-day movement. You can see here, right? Essentially, prices are still forming your lower lows and lower highs in this region itself. Over here, right? So if we look at this structure, maybe on the 4 hours will be clearer. So let's go on to the 4 hours just to see if we can see this clearer. So this is a little bit laggy. Let me just zoom into this portion of the chart, right? So in this case, you can see that for MACD, it works better in a ranging market. So maybe for one, right, we have this region over here. You can see that prices are in a bearish trend. Price also broke structure. So if you look at the highs and lows, you can see this region itself. This is the last low that was formed. Price pushed up and you can see a clear break below the structure here. So that's one. Right, so having established this bearish market structure, you can see that prices also respected this resistance area we have coming into this region. So on that break of the structure, you can see price came in, right? And essentially, this is on the 4 hours. So we want to zoom into the chart even further over here. You can see that price pushed down. So this is the resistance area that we have here. So this is an example of how you can just apply this area. So this is the resistance area that we have. You can see price broke and retested this region as a resistance, and it came into this region again. It also broke this recent low that we have, and then the pullback into the structure. So the bearish market structure is established. You have this bearish trend over here, right? And coming into this region, you can see this this area, right? So basically, price pulled up, tap into this region, right? So there are two things to keep in mind for MACD itself, right? Also, MACD holding above zero and below zero. So you can see that when prices are holding below resistance over here, MACD still sits below the zero area, right? This area over here. So what this shows is that the 26 days EMA, or rather the 12 days EMA, right? It's weaker as compared to your 26 days. So your 12 days is below the 26 days, which is why the blue line that you have on MACD, it's below zero. That's one, right? And then the signal line, which is this orange line that we have, right? This is the 9 days EMA. So when the blue line crosses below the signal line and MACD still holds below zero, then this gives us a bearish confirmation. So essentially this crossover that you see over here. So the first sign is that price fails to hold above zero, right? So it pushes lower. This is for the MACD line. And the second sign is that there is a cross right below the signal line. So you can see that the blue line, the MACD line here. So I'll bring your attention here, right? So essentially the blue line crosses below the orange line, the signal line. So this is bearish, right? So this gives us a bearish signal. And on top of that, more importantly, you can see that in terms of structure itself as well, price broke the previous low that we have over here. It pulled back, right? And you can see bearish market structure forming. And along with that, price tested this, respected this area as a support previously, broke and retested as a resistance. And coupled with that, you have this area where essentially MACD holds below zero to tell you that the 12 days EMA is below your 26 days. And on top of that, it also crosses below the signal line. So this is an example of how you can combine MACD, right, and market structure on Go. Okay, so I hope that answers your question, Trong. Okay, so if you guys have any other questions, don't hesitate to put them under the questions chat as well, right? And we'll move on to oscillators for now. Okay, so for oscillators, we will cover two oscillators, right? One would be on stochastics and the other one would be on RSI. So for stochastics, right, you can see that generally it's an oscillator, right? So not just stochastics, oscillators in general, they are bounded by upper and lower bands. So essentially the upper and lower bands would provide overbought and oversold signals. So you can see over here, right? So the upper lower bands that we have. So you can look at this example here. So you can see this region, right? So this is the upper band and this is the lower band. So essentially this area, right? This would be the overbought region and this would be the oversold region, right? And this would be the overbought region. One way you can think of this is that when price enters and exit this region, right? Because prices are oversold, essentially we're expecting price to rise. And likewise, right? When price enters the overbought region, right? you have too many people buying into it and it's driving prices higher. So we're expecting a reversal. So that is the idea behind, right? Overbought and oversold region. It works better in ranging market. And the reason why it's important, right, that we look at stochastics in a ranging market is because if we look at this example that we have on the right, this example here, essentially you can see that prices pushed higher, right? So it's forming your higher lows and higher highs coming into this region. And essentially, right, aside from that, right, you can see that stochastics itself, right, prices are in the overbought region for an extended period of time. So you see this area that's highlighted in gray. So by right, when price enters this region and exits, right, in a ranging market, we're expecting prices to push lower. But you can see that in a strong trending market, this is not going to work. So it's just going to give us a lot of false signals. And you can see this region here, right? So every time price comes in and exits this overbought region, let me just clear this. Oops. So every time price comes in and tests this region, you can see this region itself. So when price enters this overbought region, right, price pushed higher, you can see that there is just a slight retracement. So every time price exits, right, correspondingly, when price exits this overbought region, you can see a slight pullback before it continues higher. So this gives a lot of false signals, right? So if you're taking sell entries on every of the exit, right, you can see that it can wake up quite a bit of losses. So it's important that in stochastics, right, or in oscillators in general, it's important to apply them in a ranging market, right? And along with that, we also want to combine them with key graphical levels, right? So key graphical levels like our support resistance areas and trend indicators as well, right? To identify breakout opportunities. Okay, so let's look at ranging and trending market. Okay, so we'll take a look at that on the chart as well, right? So I would say that, like, in general, this session itself, it's more of a brief overview of how oscillators work. So in the next two sessions, we will actually cover specific examples on how they work, or more importantly, how we can actually use them to derive trading strategies. Okay, so that is, yeah, in response to your question, Trong. So yeah, so we're talking about ranging and trending markets, right? You can see over here, right? So essentially, as we've mentioned earlier, stochastics can stay in overbought and oversold region for extended periods of time, right? So when price enters into this overbought region that we have over here, you can see that it can stay in the overbought region for extended period of times in strong trending markets. So it's important. I think the main takeaway from this is that it's important to take note that when you use oscillators as much as possible, right, do look at the market structure, identify whether prices are moving sideways. So in a sideways market, you can see that there are no clear highs and lows. And in a clear trending market, you can see clear higher lows and higher highs being formed, or lower lows and lower highs being formed. So this is on stochastics, right? Let's take a look at the next example. So as we've mentioned, in stochastics, it's important to cover just ranging markets, right? So stochastics itself, it ranges from 0 to 100, as you can see here, right? So the upper bound is the overbought region here. So this is the overbought region, and this is the oversold region. So you can see in this example, in a ranging market, that's the first thing. Prices are moving sideways. You don't have a clear up, higher low and highs, right? So you can see these are the lows and these are the highs that we have. So prices are moving sideways. And along with that, when price exits this region, so when prices exit this region, right? So this itself is an oversold region. So when price exits this region, what this tells us over here, when it exits the region, is that it creates a bullish signal, right? So when price exits the region, you can see that in a ranging market, price push higher, test resistance, right? Once it's on resistance, again, you can see price enter into this overbought region. And when it exits this area, right, this is when we see this reversal. So you can see that in an oscillator, right, rather in a ranging market, when prices respect support resistance areas, oscillators tend to work well. Okay, so this is what we covered here. And in general, right, when stochastics is above 80 here, right, it's in an overbought region, we want to wait for the exit of the region. So this is important as well, right? So not just trading once price enters into this region, but rather waiting for the exit, because as we have covered in the previous session, stochastics can stay, or rather oscillators can stay in overbought and oversold region for extended periods of time. You can see in this earlier example, right, in a previous strong downtrend over here, right, even though prices are pushing lower and you see this region here, you saw this consolidation, right? So price entered into the oversold region, right? So by right, when price exits, we should see a strong reversal, right? So a pullback, but this is not the case here where you see that there's this strong bearish momentum continuing. So this is a trending market. You can see a strong downtrend here, and the range only comes in over here. So you can see essentially prices trading sideways. So if we have time later, right, let's hop onto the chart just to see how MACD works. Okay, so okay, I just got your question, Trong. So you want to see how MACD works on gold on the current trend. Okay, so let's take a look at that later. Okay, so with that, right, let's move on to the next slide. Let me just clear my screen. Okay, so let me clear the drawing, right? So in this example, you can see on stochastics as well, right? So we covered on overbought and oversold region. The other thing that we would like to cover is on divergence. So you can see in general, right, divergence in a bullish market, bullish divergence just means that prices are forming your lower lows and lower highs, and your stochastics is forming higher lows, right? So this is a bullish divergence. In a bearish divergence, right, it's the other way, right? So in this example, this that we have over here, this is a bullish divergence. Also, you can see that essentially price is putting in a new low, but stochastics fail to put in a new low. So what this shows us is that this bearish momentum could be slowing, right, or could be changing, and following which you can see clear movement upwards. So this is on divergence, right? Let's take a look at the next slide. So the next one that we want to cover would be on relative strength index. So relative strength index itself, right, it measures speed and magnitude of price changes. So in this case, right, essentially when price is above 70, it's overbought, right? And if it's below 30, it's oversold. So in this example, right, when price, again, right, similar to the concept of stochastics, when it exits the overbought region. So when there's an exit of the overbought region, which we see over here, right? So this is overbought. I mean, this is oversold and this is overbought. So when price exits the overbought region, as you can see, right, it should retrace or price should reverse. But in a strong uptrend, you can see over here where prices are forming your higher lows and higher highs coming into this region. When price exits this overbought region, essentially what we have is that we should be seeing a retracement or a bearish move, but this is just a slight retracement when price continue on the upside. So much as we see divergence, right, you can see this region, right? Two things to take away from this. The first one is that we have divergence, which could signal a change in trend. And the second thing is that aside from divergence, right, as we've mentioned, oscillators work well in ranging market, right? So in a strong trending market, even when price exits this overbought regions, it can also create more false signals, right? You can see that price just did a slight retracement before it continued higher. So this is on RSI. Right, let's take a look at what we have next. Okay, so just before we go on to the summary, right? So as requested, let's go on to, so as requested, right, let's go on to this. Let's go on to the trading view and see how we can actually apply MACD on gold. So let's take a look at this, right? So with recent, with respect to recent price movements, so let me just bring this up. So this is currently where we are on MACD. So you can see that if you look at the 4-hour structure, right, this is the low, right? So this is the daily low. So prices are still sitting on this daily area over here. But if you zoom in onto the 1-hour structure, you can see with the most recent move itself, prices are actually sitting, or it broke below this support area. So this is the region. So currently, right, what's important on MACD is that first thing is that it is in a trending market, right? Prices are pushing to form your lower lows and lower highs. Coming into this region, this became a support and resistance area. You can see price holding below the region and then breaking below this region, right? Breaking past this region. So for tomorrow, we will be doing a review of the setup as well. So the M15 upside confirmation that we were highlighting yesterday didn't break, right? You can see this region. So we explained earlier why we highlighted this area yesterday. So you can see that prices are still holding below this resistance area, and it continued to the downside after. So if you look at it on the 1-hour time frame, you can see that essentially in a bearish market, right? If you look at where MACD is right now, right, MACD is still holding below the 0 line. So what this shows us over here, right, MACD is showing us bearish momentum. Why? Because it's still holding below the the zero line, right? And what's also important is that the blue line itself, right? This is the MACD line. The MACD line, it's also holding below the signal line. So you have two cases for a bearish move down, right? And also keeping in mind that apart from it being in a trending market, you can see that price also broke below the clear support area that we have here. So price broke below, right? And right now this became a support turn resistance area. So this is how you can combine MACD, right? So one thing that I would like to take note of on this region itself now is that of a possible divergence that's being formed, right? But right now where it is currently, right, there isn't any divergence, but that's just something I will keep a lookout for. You can see here, right? So for a bullish divergence to be formed, you need price to form your lower lows and essentially for MACD to form higher lows. So depending on how this low is formed, right? If price pushes higher into this area, right, and above the zero line, we could see a pullback before price continue on the downside. So this is how you can combine MACD, right? I hope that answers your question, Trong. Okay, so yeah, if you have any other questions as well, do put them under the questions chat. So let's just do a brief summary of what we've covered so far, right? So we covered on trend following indicators and oscillators. So in general, trend following indicators, we covered on moving average and MACD, right? So in general, trend following indicators would work better in a trending market. It's important that we look at market structure as well. So as we've covered so far in this session, right, it's important to look at whether prices are forming your higher lows and higher highs or your lower lows and lower highs, right? And thank you so much, Hamid, right? That's very, very nice of you. Okay, so yeah, and higher lows and higher highs. And then in oscillators itself, you can see, right? So this is stochastics and RSI. So for stochastics and RSI, right, we covered mainly on divergence as well as overbought, oversold region, right? So we talk about how oscillators consist of upper and lower bound. So essentially overbought and oversold regions, right? So overbought region. So this is one thing that I would also like to highlight, which we didn't really get to cover in the earlier slides. So you can see that for RSI, right, when we have this region, so let's say, for example, RSI, it's 80 and 20, right? So we have this region. So this is our oversold region at 20. It's just bad handwriting. Sorry for that, right? And this is overbought region. So at 80 and 20, right? So essentially when you have set these boundaries, you can see that when price oscillates between that, right? This would give us less signals as compared to setting the region at 30 and 70. So when you set it at 30 and 70, essentially your range that you have here, maybe I just put it in a different color, essentially this range that we have over here, right? So essentially when price enters into this region, right, in an overbought region, right, we're waiting for a break out of the region in order to take the shots. So in this case, right, when you have a wider range you want to work with at 30 and 70, what this shows essentially is that over here, right, it gives us more false signals. So what we mean by this, by narrowing the overbought and oversold region, is making this regions, right, at a higher level. So essentially, instead of 30 and 70, if you set it at 20 and 80, then the chance of price or the chance of the indicator entering this region, it's lower. So of course, there are two sides to it, right? So one is that it will give you less signals because it is now more sensitive, right? And the other one is that in this case, right, there's also a chance that you might not catch the reversal. So this is kind of weighing in between, right? So I think in the next session, we will hop onto the charts and I'll show you guys a specific example on basically how you can toggle between this, right? And look at the difference between the 80-20 as well as 70-30 on stochastics and RSI. So we also covered bullish bearish divergence, right? So we highlighted it in a few chart examples over here, right? So essentially bullish and bearish divergence in general, right? They signal change in momentum, right? So essentially prices failing to form higher lows and higher highs, and this in turn signals reversal. So for today, right, we're covering just a brief overview of what we have for the indicators, right? So specific indicators as well as trading strategies, we will be covering in the next session as well. Okay, so I think with that, we have come to the end of the session. And tomorrow, right, we will be covering on our live analysis, right? So we will be, again, like what we did on Wednesday, hopping onto the chart setups and also showing what we have, right? So yeah, on the chart setups and also doing a review of the setups that we made on Wednesday. Okay, so I have a question, right? This is a really good question. So when to use oscillators and moving averages? Sometimes both give difference in result. Okay, so the most important thing with this, right, is that when you look at when you look at oscillators in general, right, when you use oscillators, it has to be in a ranging market. Whereas for moving average, because moving average itself is a trend following indicator, so it makes sense to use in a trending market. Okay, so what I mean by this, we just hop on the chart just to show you an example on it, right? So you can see that in a trending market itself, right? Let me just go to the 4 hours time frame, and you can see this clearly here. So let's take a look at this. So right now, right, you can see that prices are in a strong trending market, right? It's forming clear market structure with a lower lows and lower highs here. In this case, trending moving average. So you talked about moving average. So you can load the moving average over here. Generally, I like to use the exponential moving average. So this would be the moving average, right? I will usually use the 20, but you can toggle between the numbers, right? 20, 30, and 50 just to see what is it like. So let me just remove all of this. So you can see that in a trending market, right, moving average would work because it's a trend following indicator. So the nature of it is that when prices trend, right, then this itself in a bearish market structure would provide it as would serve as a resistance. So that's the idea. When you are in a ranging market, right, when prices are moving sideways, so you see this trending movement that we have, right, this area here. If I were to load stochastics or RSI even, right? So this is on oscillator. So you can see RSI itself, right, in a structure. When price exits, so by right, when price enters this oversold region and exits, right, it should give us a bullish signal. But you can see in this case, when price exits here, which is this area, you can see that this would correspond to this move over here. So you can see just a slight pullback before it continues to the downside. This is why I emphasize again and again, right? It's important that we look at market structure first, because that will help us to determine the direction. Oscillators by themselves, yes, they work, right? But you need to understand the higher time frame direction. That's one, right? And also, what is the general direction like in terms of market structure? So just look at the highs and lows that are formed, right? If there's clear high, lower lows being formed, right? Oscillators in this case is just going to give a false signal because market is trending in a very strong direction. Okay, so yeah, that's in response to the question, Dipesh, right? Okay, so Hamid, I will be on tomorrow as well, right? So you can actually go to vantagemarkets.com. Let me just show you this. So just go to vantagemarkets.com and you can check out the webinar schedule here. So let me just... Okay. Yes, Stefan. So indicators are lagging against price action, mainly on trend following indicators, right? So RSI measures price changes, so it is not a lagging indicator. But when you look at moving average, yes, it is a lagging indicator. So depending on which indicator you are talking about. Let me just, okay, yeah, it's under educational webinars, right? So for those of you guys who want to check the schedule, right, in terms of the topics that we cover and what we cover, so it's very different. So for today, right, you can go to Wednesday. So yesterday we covered on the live analysis session where we showed the trade setups and how we combine the multi-time frame analysis. Today, right, you can see that this is Thursday, so this one we will be having another session later. So for this, we will be covering on specific educational topics, and then on Friday, which is tomorrow, right? So this is me. So essentially, you can see that this we will be having the live analysis tomorrow as well, Hamid. Okay. So I hope that answers your question. So yeah, I believe we have all of the questions answered already, right? So with that, we have come to the end of the session, right? So thanks everyone for this enthusiastic response, right? I'm really glad the session is interactive. So yeah, we will catch you guys again tomorrow, right? So thank you so much, right? And yeah, I'll catch you guys again tomorrow. Take care, stay safe, right? And we will catch you again tomorrow. Thank you and goodbye.